Good morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities. Welcome to a busy week ahead. Welcome to Monday Minutes. Economic data this week. We get durable goods today. Tomorrow we have the Fed meeting into a decision on Wednesday. We've got PCE inflation measure that the Fed watches very closely. We've got China PMI. We've got another claims number, and we've got Michigan confidence. So busy week ahead. Obviously, the fiscal side of the equation is still playing out. The Republicans today expected to put their best foot forward with $1 trillion focused on more cash, more liquidity, individual checks, and obviously addressing the unemployment claims, which are due to expire at the end of this week. Let's take a brief look at some buckets this week: monetary, fiscal, and markets. Obviously, the Fed, we've been very vocal. White paper out there. We had the pleasure of speaking with Bloomberg News late last week to discuss our thoughts ahead of this week's Fed meeting. Fortunate to be included in one of their feature articles over the weekend. We expect the message from the Fed this week to be very steadfast. The message has been consistent from the Fed. They are here to obviously continue to provide support for the economy as we work through growing coronavirus cases. We do expect them to acknowledge that. We've obviously, with shutdowns across the country now, we've seen an uptick in some of the claims numbers. The reality is the job market here is still very damaged. We have over 15 million people, 15 million jobs lost. We have, in totality, with the pandemic insurance, we have somewhere in the range of 32 million people still filing some form of unemployment insurance between states and the federal level and the pandemic emergency facilities. So when we look at the Fed this week, we've talked about different things that they can do. We've talked about the in-between chatter. We do feel as we enter phase 2 of this crisis, the Fed too is changing their mindset, moving more from this mantra of stabilization of markets, the balance sheet used to date, more toward the accommodation phase as concerns rise over growing cases and second half growth. When we look at the Fed specifically, negative interest rates, we look at yield curve control, largely ruled out short term. We look at other measures such as large-scale asset purchases and forward guidance. We've talked about forward guidance in conjunction with an economic tie to either employment or inflation. Inflation seems to be the favored measure at this point. Either way, we don't necessarily expect this meeting to be the meeting where the Fed announces any demonstrative changes, but they certainly could start laying the groundwork for changes to come at the September meeting. On the fiscal side, obviously, we continue to try and hammer out some sort of deal. In our mind, it's not a question of whether a deal should get done, a deal needs to get done, focused on these unemployment insurance facilities. When you look at that, the reality is, I think most would agree, a misfire with the $600 of additional stimulus for individuals that are out of work due to the pandemic. If you look back to the last financial crisis, the federal government kicked in $25. So I think in the heat of the moment in March, it was clear that the government needed to do something. We expect that to be pared back. The Republicans are going to put 70% of income on the table, and there will be some sort of negotiation. But either way, even if we come out with a skinny deal with regard to just the unemployment claims to extend past this week, to protect the people that really have been victimized here for no fault of their own through the pandemic, I think the markets wouldn't be thrilled with that, but it would be better than no outcome at all. With regard to the markets, we continue to talk about our themes. A lot of people are talking about the equity markets, obviously off the March 23rd lows. We're close to the highs in many instances. You look at credit spreads, you look at volatility. Markets have responded to extreme liquidity in the marketplace. But when you look at the Fed's measure of M3, you look at money zero maturity, cash redeemed at par, you look at the fiscal side of the equation, you look at the monetary side of the equation, you look at where we're at in the United States, growing coronavirus cases, we have political and social unrest, we're issuing more debt than we've ever issued in our lifetime, we are printing money. Chairman Powell said specifically in his last 60 Minutes interview, the Fed is focused on printing money. So when you look at the money supply, cash in the marketplace, you look at what equities have done, you look at what gold is doing, you look at what the dollar is doing, you look at real interest rates. There are macro themes at play here, despite summer months. We're paying close attention to these themes. We think the market should. We're at critical levels. You look at real yields, you look at even nominal yields. Now hugging against the lower end of a 55 to 80 basis point range right ahead of the Fed meeting. It's going to be a busy week ahead. We wish everyone luck and a great week. I'm Greg Faranello, and this is Monday Minutes.